All right, good morning. It is Tuesday, July the 2nd, 2024. We hope everyone had a nice weekend. Obviously, a day later than we usually send the video. Most of our team was on the road for work the last handful of days, so feels good to be back. I got home pretty late last night, and my wife thinks my hair is getting too long. A little. She thinks I need a haircut. I don't know. In the Kroll household, we have kind of a split vote. What Dad should do with the hair here. I think maybe my 1.5-month-old. Maybe once he is of age to literally voice a vote. Maybe he'll. I just have a feeling he might be on my side. Might be a little hockey guy in him as well. But we certainly hope everyone had a nice weekend, and hopefully some plans here for to enjoy our nation's birthday coming up here in a couple days. So topic for this week's video, I titled it, "Are You Surprised Markets Are Higher This Year?" And markets, meaning like the U.S. equity market largely. Amazing to obviously July 2nd, kind of the halfway point of 2024. It's always nice to kind of go back and reflect, past 6 months. And what I like to do is even go a step further and just think, kind of like market expectations, what most economists and analysts were forecasting, like at the end of 2023, right? Looking out to 2024. Are you surprised markets are higher this year? I don't know. I kind of am, to be quite honest, right? If I see all the headlines that everyone else does, right? At the end of 2023, still tremendous tension geopolitically, both in Europe and the Middle East, and interest rates are high, which makes housing difficult. Borrowing costs difficult. Is the consumer going to get pinched? Is the employment picture going to deteriorate? And here we are 6 months later with U.S. equities up double digits. So are you surprised? I'm a little bit surprised, but again, that's the point, and that's why it is so difficult to forecast short-term market performance, because what ended up happening was, although there are and always will be headwinds, companies continue to make money, right? The greatest companies in the world continue to make money, profits, cash flows, which that flows right down. That is the formula for what creates the value of stocks, right? So, and I kind of touched on it. So this is our newsletter, our quarterly newsletter that I write, that we're about to send out here this week. Just walking the tightrope of optimism. Still need to we need to cut these, but these are going to get mailed out this week, our third quarter newsletter. And in here, we just kind of I touch on you can make a very rational case to be long-term optimistic. And it's important to remain rational, right? So there certainly is downside of unrestrained optimism, but there is this balancing act of rational optimism, because like in the long run, the expectation is companies will continue to make more money, right? So in terms of your asset allocation, right, and that's why I'm of big belief it's much better to rather than this year there's so much going on, I'm kind of scared to invest in equities. Instead of doing that, I think that the far better way of asset allocation is, okay, what are our families or my goals and objectives in the short term, right? So what are our goals over the next 1 to 2 to 3 years, right? And truthfully, like, that money shouldn't be in equities anyway, right? Because anything can happen in the very short term. But if you look at 5 to 10 years, like, and I don't know, maybe someone feels differently, but if you ask me, do you think the greatest companies in the world are going to be earning more money or less money 5 to 10 years from now, I think most would expect them to earn more, right? The greatest companies in the world, they're going to continue to innovate new products, improve existing services, and those profits over time should increase, right? And that in turn is what gives value to stocks, right? Because you as the stockholder, you have a fractional ownership of those cash flows and profits. So I don't know, just a little bit of, I went down a little bit of rabbit hole there, but again, hope everyone enjoys the third quarter newsletter. We should, we're going to get that out this week at some point. So looking at markets last week, okay, so equities, roughly flat, mostly on the economic data front, mostly disappointing. Consumer confidence came in a touch lower than expected, new home sales a little lower. I guess maybe the one good piece of news was the PCE data. That's the Fed's preferred inflation metric. Came in flat. So those kind of rooting for a rate cut. That news would certainly be welcome to them. On that, we kind of had the yield curve, which remains inverted, but started to steepen a little bit last week, which in terms of like long-term growth, that's an encouraging sign, right? You had the front end of the curve, shorter term rates drop a bit while the longer end of the curve increase. So that's good news. Economic data this week, the big one's going to be Friday. So we'll receive May's employment data, the jobs number there, which is always a big one for the Fed and for just the market in general. Also, ISM manufacturing data, which is a good number to keep a look out for as well. So besides that, we, behalf of our whole team, wishing you and your families a happy 4th of July, our nation's Independence Day, a birthday. So we hope you have a great week. Those of you that are traveling, safe travels, and certainly do not hesitate to reach out to our team if we can be of help in any way. Hope you have a great week. Thanks.